This topic is about financial claims of lenders and shareholders from Learning Module, investors and other stakeholders. The cost of debt is 20%. The firm's return on its assets is 30%. Because 30% is higher than 20%, borrowing money at 20% and earning 30% on it gives extra return to the smaller equity portion. Higher ROE. This is the benefit of financial leverage, but only when return on assets is higher than cost of debt. Company B has higher ROE because it uses more debt. The firm earns more on its assets, 20% ROA, than it pays on debt, 10% interest. That spread makes leverage boost ROE, but higher leverage equals higher risk. If profits drop, Company B's ROE will swing much more than Company A's. Suppliers depend on the company paying them on time. If the company has big debt, it must pay interest and principal first. That makes cash flow tighter and increases the chance of delays or default. So, suppliers face more risk of not being paid reliably. Debt investors get fixed interest payments, predictable but capped. Equity investors don't get fixed payments. Instead, they share in the company's growth. Equity can go up a lot if the company does well. Unlimited upside potential. Senior secured debt is safest, gets paid first. Value doesn't swing much with company performance. Subordinated debt riskier than senior debt, but still capped returns. Common equity is last in line. Residual claim. If company value rises, equity holders gain the most. If company value falls, equity holders lose first. Residual claims belong to shareholders, not debt holders. Discretionary payments are dividends to shareholders, not interest. Interest payments are contractual, must be paid, and they reduce taxable income because they are tax deductible. Limited liability is true for debt holders. They can only lose what they invested. Priority of payment is true for debt. Debt holders get paid before shareholders. Unlimited potential return belongs to equity, not debt. Debt holders only get fixed interest and principal back. Debt interest is tax deductible, lowers taxable income. Equity dividends are not tax deductible. No tax shield. If taxes rise, the value of the tax shield from debt increases. That makes debt financing relatively cheaper than equity. This topic is about corporate stakeholders and governance. Maximizing shareholder returns at all costs sounds good, but it ignores other stakeholders and risks. Independent audit committee is very important because it checks financial reporting and ensures management is honest. Management overseeing financial reporting directly. This is risky because it reduces transparency and increases chance of manipulation. Shareholders want maximum value. It includes profits, growth, dividends. Management sometimes has different personal goals, such as job security, prestige, perks. These goals can lead to decisions that don't maximize shareholder value, like avoiding risky but profitable projects or spending on prestige projects. This is called the agency problem, a conflict between managers, the agents, and shareholders as the owners. Activist shareholders buy shares and then push for changes. Their goal is usually to increase shareholder value, such as stock price, dividends, and efficiency. They do this by pressuring management on things like strategy, governance, or how money is used. Social or employee issues can matter, but the primary focus is financial performance and shareholder returns. Bank lenders usually negotiate directly with management, get covenants, and see private financials, so they have good access. Private market debt holders also negotiate customized deals, often get non-public info, so they have better access. Public market debt holders rely on public disclosures, such as financial statements, credit ratings. They don't get direct access to management or private data. Shareholder theory focuses only on maximizing shareholder value. Stakeholder theory considers employees, customers, suppliers, community, etc. In this case, the board invests in employees, a stakeholder focus, because it will increase shareholder value in the long run. That means the decision is not a violation of shareholder theory. It actually aligns both theories. Shareholder theory has one clear goal: maximize shareholder value. Shareholder value is easy to measure, such as profit, stock price. Stakeholder theory must consider employees, customers, suppliers, community, environment, etc. Each group has different needs. Sometimes they conflict, such as higher wages versus lower costs. That makes it harder to define, measure, and balance all objectives at once. Fixed salary gives security, but no link to company performance. Managers may not care about shareholder value. One-time cash bonus pushes managers to chase short-term results, even if harmful long-term. Stock options that vest over years are managers' benefit only if the company's stock price rises over time. This ties their wealth to shareholder wealth. Public bondholders are many investors, dispersed, no direct relationship, relying on public info, hard to coordinate. Bank lender is one main lender, has ongoing relationship, access to private financial info, and easier to negotiate directly. So, renegotiating with a bank is usually more efficient. Staggered board our directors are elected in rotation, not all at once. Harder for shareholders to quickly change the board. Inside directors are company managers themselves, less independent, more likely to protect management. Chairman that is also CEO concentrates power, reduces independence, harder for shareholders to challenge management. Non-staggered board with independent directors are all directors elected annually. Majority are independent, not company managers. This makes it easier for shareholders to push for change. Debtholders, employees, and other obligations get paid first, not shareholders. Day-to-day management is the job of managers, not shareholders. Shareholders get what's left after all debts, wages, and other obligations are paid. This topic is about corporate ESG considerations. Even though a board is responsible for oversight, as governance, the source of this specific risk is the treatment of people, making it a social risk. Social controversies and brand boycotts can lead to material financial losses and a decline in consumer trust. Option C uses the phrase social environment, but the environmental category in ESG is strictly about the physical natural world, like air and water, not the business or social setting. Governance information is usually found in standard public documents like annual reports and proxy statements, which have been used for decades. While environmental and social factors are becoming very important now, the question asks what has historically been the most reliable. Governance has a much longer track record of being used in financial analysis. Negative externalities mean costs stayed outside. Internalized costs mean costs are brought inside. Regulations and taxes as the tools that force companies to start paying these costs. Modern analysts don't just see this impact as bad PR, they see it as a quantifiable financial cost that reduces the company's actual value. Physical risk is the risk of damage from climate events such as storms, floods, heat. Transition risk is the risk of losses from changes in policy, technology, or market preferences as the world shifts to low carbon economy. Social risk relates to community or labor issues, not directly about asset value. Stranded fossil fuel reserves lose value because of transition to clean energy. This is transition risk. Stranded assets are not used because of regulation, technology, or demand shifts. This is about economic transition, not physical damage. ESG has many possible issues: environment, social, governance. Not all of them matter equally for every company. Materiality means focusing only on the ESG factors that have a real financial impact on performance or valuation. This helps analysts avoid wasting time on factors that don't affect shareholder value. Environmental pillar covers climate, pollution, resource use. Social pillar covers employees, communities, customers. Governance pillar covers how the board and management run the company, including oversight, accountability, and risk management. Since the board's role is about oversight and governance duties, this belongs to governance, even if the risks they review are environmental or social in nature.